Hey everyone, Logan Hertz here with Hazeltine LLC. I have with me back again DeAndre Clayton of Clayton Financial Solutions. DeAndre, how are you doing?
I'm good, man. I'm good. I'm not on the mend anymore. I'm feeling good. I'm feeling strong. I'm back out here in these streets. Just kidding. I'm just
Excellent, excellent. Good to see you. So we are continuing with kind of a topic that I've been exploring and that I've gotten some feedback that people want to see more of, and I think it's a great topic to explore, which is combining velocity banking with infinite banking. So what I do is really infinite banking. I know enough to be dangerous when it comes to velocity banking. I think it's a great strategy. I'm an ambassador for the First Lien HELOC program. But what we kind of want to start to show is how when you combine these two, you end up with an even better overall strategy and even more optionality. It's a word I love to use. The more I learn about velocity banking and infinite banking, the more I'm not as focused on the numbers and I'm more focused on the intangible, non-quantifiable benefits it has. It gives you number one, having control, the flexibility, the liquidity, the peace of mind, the optionality, all of those things that is very difficult to quantify and to show visually, but you really start to appreciate really only after you start doing them, right? Like I don't think too many people who are doing velocity banking and infinite banking are sitting there with their spreadsheet, updating it every day, right? I don't
no,
think that's what they're doing, right?
no, no. Definitely not. Definitely not. I think for the average person like us who engages in these different concepts, um, it seems like our lives just kind of fall into place with them. Where we're just in the middle of living our lives using these concepts, and we just know it's going in the right direction. Like we could see the accounts growing. We could see ourselves paying debt off very quickly. We can see ourselves having access to money all the time instead of just some of the time. And I think that that's really kind of where it lies, where, when your strategy requires so many different metrics to be hit, there's a lot of stress that comes with that. And so, velocity banking, infinite banking, I think there's a meme that I've seen, especially like when Wall Street goes bad or when something happened. It's like this guy who's walking with his wife, which is stocks and stuff like that. And then he's like turning his head when somebody, when an infinite banking guy walks by, like, what's that? It's because we just so carefree, really, about what could happen to us. It makes us feel somewhat impenetrable. Obviously, we have health issues and stuff like that that could happen, but financially, it is a much easier way of life.
Yeah, yeah. It's doing what Robert Kiyosaki says, which is don't work for your money, make your money work for you.
Yeah.
And we know it's working for us 24/7 within our First Lien HELOC and within
Mhm.
our infinite banking strategy. And it's automated, right? It's not something we have to consciously think about. We know that we're doing it. So we're going to talk about a potential use case today, just a quick little example that we're going to go through um, to show how this works. And we're going to start with the velocity banking piece, and then we'll look at the infinite banking piece, and we want to show how these work together. So this is someone who has a $300,000 mortgage that they just refinanced into a first lien HELOC. So they have 300,000 in their first lien HELOC. 6% is the interest rate, and they have monthly net income of $10,000 and monthly expenses of $4,000, right? Homeowners insurance, property taxes, etc. Okay, so this is just the velocity banking piece. If we look at this, if they do velocity banking, meaning they're running their income through their HELOC, they're going to pay off their house in a little over 5 years. And over the course of those 5 years, they would pay $49,000 in interest. Now, I'm not showing here the whole comparison to the mortgage. And the reason is because that's not the intent of this video, right? The assumption is this person is already going to do velocity banking. We can show a comparison to a mortgage. Of course, you can use a mortgage if you want and still do infinite banking. Nothing wrong with that. But we're showing someone who's already doing velocity banking. So 5 years to pay it off. and $49,000 in interest paid. That's what they're on track for. Okay. Now let's layer in infinite banking. So this person says, hey, I also get this whole infinite banking thing. I want to do that. I want to start a policy, right? Well, the challenge is if you start a policy, guess what? Your monthly expenses now go up because you need to pay the premiums on that policy. So wouldn't that be a bad thing? Well, when you pay the premiums on that policy, we know that's not money that's leaving your personal economy, right? When you pay a premium into your infinite banking system, you are permanently capturing those dollars in your economy where they can never escape in your banking system and where they earn for you tax-free from now until the day you die. There was someone who recently said, I'm sure it's not original with him, I think this goes back a long ways. The difference between someone who's rich and someone who's wealthy is that the wealthy person finds a way to not ever give back the money.
Hmm.
People who get rich
Yeah.
sometimes don't stay rich because they have to give back the money, right? They give that back the money in lots of different ways, taxes, they living expenses, whatever, right? They give back the money. The wealthy person doesn't ever have to give that money back because it's all captured in their whole life policies where it keeps earning and it never goes away. They're just borrowing against it using policy loans, but they're never actually using their own money, right? So we have to understand when we're paying a premium into a whole life policy, that money is not leaving our personal economy. But let's put that to the side for the moment and treat it like it's an expense. So let's flip over to the whole life policy. So in this example, this is a 35-year-old healthy male who's going to take out this particular policy with a $25,000 annual premium. Okay. And we can see how this policy grows over time. And then they're going to use the policy for retirement income. So you can see here, we're taking about $80,000 of tax-free retirement income out of
Wow.
the policy
Wow.
for 20 years. Okay. And then when we're done taking $80,000 a year, we still have 1.4 million in the policy in cash value, and we still have 1.8 million in death benefit. Okay. So very powerful stuff. Again, the purpose of this video isn't to go deep into infinite or velocity banking, but to show how they can be combined. Okay, so this is the whole life policy that we're going to use for infinite banking. Again, this is not showing infinite banking per se. This is just showing the whole life policy that will be utilized to become your own banker. Okay, so it's a $25,000 annual premium. So if we go back to our First Lien HELOC, that means our monthly expenses have increased by this amount. So $25,000 annually translates to a little over $2,000 a month. Okay, so we need to add this $2,000 a month to our monthly expenses. So our monthly expenses go up from $4,000 to $6,083.33. Okay, what did that do to our payoff? Well, now it went up from 5 years to 9 years. So instead of paying off our house in 5 years, now it's going to take us 9. And now we're going to pay $90,000 in interest instead of what it was before, 41. So let me go over here. So again, in that first scenario where we paid off the house in 5 years, this is not IBC, no infinite banking, okay? We pay $49,000 in interest. We pay off the house in a little over 5 years, okay? If we add in the whole life policy, right? Now we pay $90,000 in interest and we pay off the house in 9 years. So we added a cost of $51,000, right? We're paying an additional $51,000 in interest, and it's taking us an additional 4 years to pay off the house, right?
Mm-hmm.
Okay.
Yes.
So is that $51,000 worth it? What are we getting from this whole life policy, right? What are we getting from this whole life policy? Well, instead of showing you the whole life policy, which I'll get back to in a second, I want to show you from another video I did, the cost of waiting. Okay. So if we wait 1 year with that exact same policy, so instead of taking out the policy at age 35, right? This is just a summary of what I showed you before, right? We can get about 1.6 million in retirement income, and we'll still have 1.4 million in cash value left over. So it's a total cash benefit of almost 3 million. If
Wow.
we delay taking out that policy by 1 year, we get $200,000 less in retirement income and $150,000 less in death benefit, right?
Wow.
So, and that's in these numbers here. I have that policy too, but I don't want to go too deep into the weeds. If we wait 2 years, so we wait from age 35 to age 37, and we take out that same policy, $25,000 premium, we will get almost $400,000 less in retirement income. If we wait 3 years, so we wait from age 35 to age 38, and we take out that same policy, the cost of waiting is almost $600,000. We'll have almost $600,000 less in retirement income because we waited 3 years.
Wow.
So, is it worth paying $51,000 in additional interest over 9 years in order to get over $600,000 in retirement income? I would say yes.
I would say yes.
I would say yes.
Absolutely.
Now let's go even a little deeper, because we're assuming in this HELOC calculator, we're assuming that that $25,000 we're paying into the policy is just gone. We're not doing anything with it, right? But we know that's not the case. We're not just paying $25,000 for a car, right? We're putting it into, or for food or something, because something we consume, right? We're putting it into a cash flowing asset. So when we make that very first premium payment, $25,000, we immediately have $13,000 in cash value. And this is where the beauty of merging velocity banking with infinite banking really comes in. Because if we wanted to, we could take out a $13,000 policy loan in year one and put it back into the HELOC, meaning the net out-of-pocket cost to us in year one would only be basically $12,000. So we're not actually coming out of pocket $25,000. We're really only coming out of pocket $12,000. And we could do that every year if we wanted to, right? See how our cash value grows, right? So by year 5, we have $100,000 in cash value in the policy. You know what we could do if we wanted to? We could take out a $100,000 policy loan and pay it right into the HELOC.
Good.
Right?
Yeah.
So let's take a look at the HELOC. Let's take a look. Where would it be at the end of year 5? So year 1, year 2, year 3 is 36. Year 4 is 48, right?
Right.
Year 5,
60.
is this remaining balance? Is that what that is?
So the equity is on the far end, the 140.
So we still owe $156,000 on the house at the end of year 5. If we wanted to, because now we have 100,000 in cash value in our whole life policy, we could take out a policy loan and pay that down by $100,000, right? Dramatically reducing our balance if we wanted to.
Good.
Right. So I'm not going to show that here. I'll probably illustrate that in a different video. But the beauty of it is now it's up to you. Now you have options. If you want to use your whole life policy to pay down your HELOC, you can. If you want to pull more from your HELOC to pay a larger premium into your whole life policy, you can. You can do that too, right? It's totally up to you. You have total control and flexibility over both of these assets, right? And now you decide, right? But one of the key points I'm making here, obviously, the overarching message is the control and flexibility that both of these strategies give you. So it's not primarily about the numbers. However, I do want to point out that when you take out a whole life policy, in addition to your first lien HELOC, you will delay the payoff of your house. You'll delay the payoff of any debt that you're paying off because you have to redirect cash flows away from paying down the debt to your whole life policy. But is it worth it? I think we've shown the numbers pretty dramatically show, yes, it's worth it. If you delay, because again, in whole life, the most important element is the passage of time. The best year of your whole life policy is the last year it's in force. The worst year is the first year from a
Mhm.
cash value standpoint, right? So if you delay even 1 year, you're talking about multiple six figures worth of opportunity costs. And that's a cost that you don't see. That's what's so important, right?
Yeah.
This right here, this difference in interest, you see that. People see the interest they're paying to the bank and they feel pain and they hate the bank and they want to cut that down as much as possible, right? And we got to kind of resist that temptation and say, hold on, let's think big picture. Let's think big picture. In this example, I'm delaying the payoff of my house by 4 years and I'm
Mhm.
paying an additional $51,000 in interest. Okay.
Yeah. And
If
and
I delayed my whole life policy by 5 years, right? So if I just did the straight up pay down and didn't take out a whole life policy for 5 years, the cost of waiting would be significantly more than what's shown here. This is just showing you waiting for 3 years. If I even delay 3 years,
mhm.
it's over $500,000 in retirement income that I'm giving up.
And there's a few things that you're delaying as well. What if a health event happens? You know,
Yep.
um, do you have the money to handle that health event, or are you gonna go into the tunnel like many Americans who do run across a serious health event and be in debt for the rest of their life due to this health event? Um, and the other portion is, although we're using the concept of just looking at what the insurance policy is doing, which is a layered approach because the insurance policy is not only providing a death benefit, so it's creating a buffer for the debt that you may be squeamish about, the additional 4 years of debt that you're squeamish about. If something did happen to you, the death benefit pays out way more in that
Mhm.
time period than how much you would have spent on or you would have saved on that difference. And remembering that this is a client who already decided that velocity banking was for him. So why is that so important in this particular metric? Well, Logan didn't want to touch on it, but me being who I am, I had to look at it, right? Um, I ran a metric on a client having a 3% mortgage.
Do you want to share something, DeAndre, or are you just talking to it?
Sure, sure, sure. I'll share it because the what you were talking about was the difference on the 51,000. That difference on the 51,000 that Logan is actually discussing is only talking about if he was in the HELOC versus not having IBC or including IBC. But that's not true of the whole picture. The whole picture is he chose velocity banking because it was going to save him money from the start. That was the only reason why he got into it. And he also wanted access to capital. So in the same illustration, I'm going to show you guys something frightening here. Same client, 300,000, 3% as the interest rate on the mortgage, 6% as the interest rate on the mortgage, as the interest rate on the HELOC. And we're taking the IBC loans out to be able to fund the policy. We're taking the IBC money out to be able to fund the policy. You're still spending more on the mortgage at 3%. You're still spending, and the difference actually equates to being $106,280.92 from not having the money come out to fund the policy and having the money to come out to fund the policy from the HELOC standpoint. So that money was already there. That 51,000 was already, you were already going to spend that anyways, which Logan wasn't actually showing because he wasn't doing a comparison of the mortgage. But that is another layer of it. So now when you get into this mindset of, okay, well, I don't want to spend that much extra money. I don't want the interest to rise like that. The interest is not rising beyond what you were already normally paying on your original loan, which is
Right.
kind of crazy to think that you can get an insurance policy, have a HELOC, and still spend less on the actual loan to fund it. So there's so much more value that you're getting out of this approach of velocity banking plus infinite banking.
Yep, you are paying interest regardless. It
Yeah,
does
you're
not matter
paying
which
regardless.
approach you
Yep.
take.
Yep.
And I want to show something even more than you inspired me to show something else. So here, again, we're showing you taking, $25,000 a year, paying it in premium. So it's coming out of the HELOC. Now, we showed you how, because you have cash value available to you in your policy right from the get-go, you could use that cash value and take out a policy loan and put it back into the HELOC if you wanted to. Whether you recommend doing that or not, I think it's important to show you what is the net out of pocket, like what is the net cost to you. Okay. The net cost to you is not this $25,000 annual premium, right? Because that $25,000 isn't leaving your personal economy. The net cost to you, or it's the net loss of liquidity. It's not even a cost long run because you get it all back, are these numbers here. So minus 11,000 in year one, minus 10,000 in year two, minus 4,000 in year three.
Right.
And then you go positive. And now every dollar in premium you pay into this policy results in more than $1 of cash value. So you now have a magic bank account where every dollar you pay in results in more than $1 of cash value. So really, if we wanted to show the true net effect, the true net cost of this policy, let's go back and put his monthly expenses to what they were without the policy. So $4,000. Okay.
Mm-hmm.
And now let's add in the actual net cost, which are these numbers here. Okay. So it's actually 11,685 plus 10,221 plus 4,447. $26,353 is the total loss of liquidity you will suffer over the first 3 years. Okay. So really, one way of doing this, and even this is handicapping the system a bit, because I'm going to assume you take that hit all in year one instead of spread out over 3 years. So what I'm going to do now is I'm going to go back here. Okay. Keep your monthly expenses the same. And I'm just going to add this $26,000 to your balance. So instead of $300,000, it'll be 3,026, 353.
Correct. Yep.
All right. So what do we do now? So now we added half a year. We added 6 months. And how much in interest did we add? What? So this is the true difference, let's call it the true cost, right?
Mm-hmm.
59,232,
Wow.
right? So really the true difference is what? 10,000, roughly 10,000.
Yeah, roughly 10. Wow. And for how much income are we
And
doing
and you
this
and
for
it
again?
went and you added 6 months, right?
And how much income are we doing this for again?
How much income?
Yeah. Yeah. How much income are we doing this for again? On the
Income.
IBC stuff.
Oh, how much income did we get?
Yeah. How much income did we get again?
So over 20 years, we got $1.6 million in tax-free income.
Oh my goodness.
And when we're done taking all that income, we still have 1.4 million in the policy.
Oh my goodness.
So a total cash benefit of nearly $3 million. That's what we're doing.
That's incredible.
Not to mention a death benefit of 1.8 million left over. Right?
That's impressive. Yeah, that's definitely impressive.
So really, if we're looking at the true cost of taking out this policy, when we net it out from a cash perspective, the true cost is a little over $26,000, right? This number here. That's the total loss of liquidity you have to weather over 3 years. So there's $26,000 you're putting into the policy over the first 3 years that you cannot take back out. It went to the insurance company, it went to cover mortality costs, etc., right? Went to pay that evil agent who sold you the policy, right? Can't believe they allow him to do that, right? He made money. How dare him? All right. So
Add that part of there. Oh, man.
So that 26,000 is really what you're paying. So again, so the true cost then in interest that we're adding is again 59,000, right? So now, because we dumped that additional $26,000 cost into the balance, we now pay off the house in 5.5 years instead of 5, and we pay $59,000 in interest instead of 51,000, excuse me, 49,000. So basically, we paid an additional $10,000 in interest, and we delayed our house payoff by 6 months. And what did we get in return? 1.6 million in retirement income over 20 years from age 66 to 85, with the remaining 1.4 million left over after we're done taking that income, for a total cash benefit of nearly 3 million,
Wow.
not to mention a remaining $1.8 million death benefit.
So here's what's really crazy about this, Logan. Um, we know what the standard, designs of a retirement usually is when it comes to retirement income. And it's usually that you're only supposed to draw 4% off of a nest egg, right?
Mhm.
So to
Mhm.
put that into perspective for a lot of folks is in order to draw, at least in the ballpark of what Logan is showing us in this example, you would have to save $1,980,000 into a retirement account. Now let's put that into further perspective. There are only 6% of people, or 0.6% of people, I believe, that actually reach has $1 million in a retirement account.
And by the way, that $1 million in the retirement account, aren't there taxes due on that?
There's taxes due on that.
Can
So
they
we're
can they touch the money whenever they want?
right. So I only ran it based on an account value. I didn't even include the fact that you have to have, the 30% taxes or 22%, 24% taxes to come out of it to net the 79,000.
And that $1 million in their retirement account, does it magically double to 2 million if that person dies, so their heirs get 2 million instead of 1
No,
million?
no, it doesn't at all.
And if that person has some sort of long-term care need, do they then have
Uh,
2 million instead of 1 million available to use for long-term care?
no, no,
And if they get a terminal illness, do they get 2 million that they can use to
no,
for healthcare or whatever?
no,
Hmm.
no. Yeah,
And
that's
if you want to use that money, don't you have to withdraw it? You can't, it doesn't keep earning for you while you're using it, right?
yeah, you got to withdraw it. So that this is eye opening. If this isn't eye opening to you guys, I don't know what is, right? Because the chances, and it's funny because oftentimes when we talk about infinite banking, I don't know, Logan, you've probably heard this a lot when people say, "Oh, you got to be rich to infinite bank," right? And what you're noting, what you're noticing is this $25,000 amount that is the contribution. And where did
Mhm.
it come from? Well, it came from the savings on the HELOC, obviously, and being able to
Mhm.
use it. But the other metric of that is maxing out a regular retirement account. That's about the range of it. It's
Mhm.
close to
Mhm.
$25,000. It's about the range of it. Maxing out a
Yeah,
regular
yeah.
retirement.
If we're talking about you getting 1.6 million in income, right? Let's say you only contributed half that amount. So you only
Yeah,
did $12,000, so that's
yeah,
$1,000 a month. And
yeah.
that gave you, if that gave you $800,000 in additional tax-free retirement income, right? Plus probably $400,000 still left in the policy when you're done, plus a nice death benefit. I mean, that's moving the needle on your
That's moving
retirement.
the needle. That's moving the needle.
Cut it in half again, right? You
Right,
contribute
right,
$500 a month to a policy.
right.
If we keep the numbers consistent, that'll give you at least another 400,000 in retirement income,
Yep.
plus additional leftover, plus a death benefit. 400,000 in retirement income, I think that'll move the needle for people, right?
It's more than most people have. I mean, realistically, if the amount of people who reach a million is only 0.6%, out of a retirement account. So basically, Edward Jones says it's 70 million participants, 422,000 of them are in the past $1 million club, right?
Mhm.
So you would have to assume that it can't be that many people who are at 500,000. I mean, if it's 0.6 that make it to a million, I'm not
Mhm.
going to assume that 90% make it to 50, 500,000.
Mhm.
That would be obscene. So even on the lower end, as the contribution drops on this design of what we've created, it's still going to do better than what the average person is actually going to accomplish. And there's a reason why, right? At the beginning, Logan talked about the stuff that you don't see and how big of a difference the stuff you don't see makes. In this design of what we just showed you, there's no risk tolerance or risk capacity.
Right,
You don't have to manage your emotions doing this.
right. We are not taking on market risk. There's
We're
no,
not,
we have a guaranteed result.
you have a guaranteed result. I remember watching, I was looking at LinkedIn recently. I don't know if you follow Brent D. Gardner. We need to give him a shout out, especially when this video comes out. So Brent has been in the insurance industry. He's a CLU, but he's been dropping gems as of late about the history of the insurance industry. I'm talking about stuff back from the 1830s, 1932, and really
Wait a
share.
minute. I thought whole life insurance was invented by TikTok.
Oh, what? No, no, no. Gosh, that's hilarious. So funny enough, now we realize in the insurance industry that there are some strict laws against moving money from different accounts, right? Different retirement accounts and into a fixed account. And that's what the government has put in place. But those laws were originally from insurance companies, which I didn't even realize that when A.L. Williams came around with the buy term and invest the difference, people were surrendering their whole life policies and buying term and investing the difference. And the insurance companies were like, what are you doing? Like, you have guaranteed growth here. You've been getting, you're able to get retirement from it because they had the history of retirement, right? And so one of the journals he dropped that was really, really interesting was sharing how the origin was that insurance policies were used as retirement income vehicles beforehand. So it's not new that people could, LERP and all this other stuff, all these people using these different words now to describe it. This isn't new. It actually started off that way. And the transition happened when people wanted to go after your money and put it into Wall Street and risk it and say that they could possibly earn you more. But the reality is, the average American really just wanted to make sure that their dollar was able to go faster than inflation. That was it. They didn't need a short term 25% or anything like that. They just needed to know that they were never going to have to worry. And this design that Logan is showing you, it's a design that is focused on your mental health as well, of you not
Exactly.
being I can't tell you, I don't know if you ever deal with this, Logan, but I know I deal with it all the time. I'm going through a person's portfolio and we're talking about some different things and I'm trying to help them with insurance. And then I might ask them a question, especially in around annuities. I might ask them a question about, okay, so right here in this account, about how much do you have there, right? And you know what happens a lot of times?
Oh yeah.
I, DeAndre, I can't tell you. You know what? I don't look at it because I'm scared.
Yep.
I'm scared of what it may look like.
Someone in the business calls that financial PTSD, and it is real. It is
Right.
very real. you know.
Right. So when you're looking at what we're presenting something that you don't have to control your emotions to do.
Mhm.
That's the brilliance behind it. You can
And
still
you have
do it.
control.
You
I
have
can't
control
control what the S&P 500 is doing. Can you?
at all.
I don't have control over that.
At
No.
all.
I can control where my cash is flowing. That I can control. And to further DeAndre's point, let me come back and say, you know what? It's not about the numbers, because some people just hate debt and they say, I just want to be out of debt.
Absolutely.
And this gives you the option to do that. So you could say, you could look at me, because I do have some clients like that, and they're like, you know what? I don't care about these numbers. I just hate being in debt and I want to get out of debt. And I'm like, great. Then let's do that,
And let's
because you're going to be better off if you have the peace of mind that giving you debt free gives you, right? If you're, there are people who they just don't want to be in debt and they want to get rid of the debt. And I'm like, you know what? Then that's what you should do. It doesn't matter what the numbers say. If
right.
paying off your house, and then they'll probably never use the first lien HELOC because they don't ever want to be in debt. So just use the first lien HELOC to pay off your house as fast as possible. And then take, for what you should do is take out a convertible term policy today. So take out a convertible term policy. So you've got your spot reserved in line for your future whole life policy.
Yeah.
Your insurability is locked in. And now no matter what happens to your health over the next few years, you have the ability to do it. And you have that death benefit protection. Of course, God forbid something happens to you.
Mm-hmm.
Pay off your house. And then when you're ready, we'll do the whole life policy. And if you get less, you're probably going to get more in retirement income, just because you're going to be in a better psychological state, right? Because now you'll feel
Stick to
free.
the
Like,
plan.
okay, now I have no debt. I don't owe anyone a dime, right? I can show you why that's not the most efficient, effective way of using your money. But again, to your point, DeAndre, there's a huge psychological impact to this. So again, you can do it in the way that makes the most sense for you. And that ultimately is not a numbers driven decision. I
Mm.
love showing numbers and working through scenarios all day long. I love it. I can play games with them and show you all kinds of things. But at the end of the day, I always tell my clients the same thing. If you make your decision based on numbers, you're going to be disappointed. Okay.
Right.
Because ultimately, there are always assumptions that go into those numbers.
Right.
We know it's not going to work exactly the way we've modeled it out. We know that.
It ain't far from
We're using the numbers
it.
and the scenarios to
Ain't far from
illustrate
it. Right.
principles, right?
Mm-hmm.
But ultimately, over time, I think the value that people get out of infinite banking and velocity banking is how much control and flexibility it gives them in their
And
financial plan.
peace. 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 You
Yep.
cannot you cannot overemphasize that, right? Peace is
What's the
extreme.
stock market doing? I don't know. I don't care. Why would I
I
follow
don't
such a
know.
thing?
I don't.
Where are tax rates? I wasn't paying attention. I don't know. Who cares? What's the Fed going to do? Where are interest rates going? I don't know. I'm not paying attention. Like, who
I'm
cares?
not paying attention to it. I don't live in that world, right? And I'll say this: if you don't listen to us, listen to some of the best investors. Warren Buffett says he believes the S&P will be slashed in half in the next 10 years. Half. What do you think that means? Where's your money? For most people, if they tell you to invest in something, they're going to tell you to invest in the S&P 500. The numbers are overinflated. There's more money there than there is in our actual economy. You have to start thinking about how economics works to actually plan out how you use your money and how you build your money. You can't just sit here and live in this make-believe land where IOUs keep happening. IOUs, someday the Pied Piper is coming. That's just the reality. And especially in regards to taxes. If you believe that taxes will not increase, but you see all this stuff going on, something is wrong with you. So plan better.
Well, this has been fun. We'll do a lot more of this. This was one illustration of combining velocity banking with infinite banking, showing how they can work together. And we barely even scratched the surface of this topic, but hopefully a good introduction for people.
Yeah.
So, DeAndre, thanks so much for your time. We look forward to the next one.
Hey, man, always a pleasure.